Hey there, great people. Thanks so much for dialing in. Touching base to let you know that as with all of our content, this is general in nature. It does not take into account your specific or personal circumstances nor your individual risk profile, and as such should not be acted on accordingly. If you get value from this and you want to explore some things further, I strongly recommend that you get personal advice from a qualified professional. Hello and welcome, everyone. Very excited for today's guest, Mr. Scott Phillips from the Motley Fool. Very keen to deep dive around your money philosophy, Scott. Thanks heaps for joining us.
John, g'day. Thanks for inviting me, mate. It's going to be fun. Looking forward to it.
Very, very good. So just to go around your origin story, nice and easy to start with, Scott. How did you make your first buck?
First buck, selling ice creams at the football and the cricket. I had a mate who had an in with the company that did it. And you could rock up, you got your float, you got your ice cream strapped around your shoulder and literally walked around yelling ice creams, ice creams. So many more in the cricket than in the footy. But yeah, the Sydney Cricket Ground, I'm a Sydney boy by birth. So Sydney Cricket Ground and the old football stadium was where I earned my first money.
How good is that? Get a free test match along the way. Yeah,
that was always, I saw State of Origin, I saw Test, it was great. I should say actually my first buck, I lied. My first buck was washing cars in the neighbourhood for $2 a car. That was actually the very first, now I think about it.
Even better, even better. And Scott, what sparked your interest around investing?
Dumb luck and probably some sort of wiring for it. I credit my high school teachers. I had a year 8 or year 9 maths teacher, Mr. Moyer, who taught us about compound interest. And I don't remember the stats he used at the time, but it was something like if you invest a certain amount of money when you're 18, if every year till you're 30, you'll have $1 million by the time you retire. And that one was just one of those light bulb moments where you go, that sounds cool. I would like $1 million. That would be nice. So that was the first little spark. And I had a great economics teacher in year 11 and 12 who sat us down. I'm old, John. Back in the day, there wasn't an internet. There was a time, and with the physical newspapers had the share tables in them. And so you'd go through and you look at the code BHP and you look at the market capitalization, the price earnings ratio, and the dividend yield, and all that good stuff. He talked us through all that stuff. And we used to grab the Fin Review and the Herald. We had them both at the time at the school, and you'd pour through the page and look at all that stuff. So they were the two kind of foundational moments. But I will say, I think I was wired for it. I remember in year 8 commerce, I had a teacher who tried to teach about supply and demand and tried to say, well, supply and demand intersect, and this is how much they'll produce. And I put my hand up and said, won't the companies make the number with the number of products that maximise their profit? And it's like, no, that'll come in a couple of years. But now all you need to know is supply and demand. So I was probably born for it. There's some wiring somewhere in my brain that made me business focused from a young age, and investing was part of that.
Brilliant. Well, thank you, Mr. Moyer, in years 7 and 8.
And Mr. Barnett, the economics teacher. So
and Mr. Barnett, the economics teacher. So, and just take me through like early doors when you're dipping the toe in investing, Scott. What are some of the early mistakes or wins that you had?
Oh, massive early mistakes. Make the mistakes early, by the way, when you haven't got much money, because then they're not too expensive. I was stupid stuff. I tried to trade. I had a mate at work, and MIM, Mount Isa Mining, was the company. He said, all you do is you buy when it's low and you sell when it's high. It's that easy. And of course it is until it isn't anymore. So I lost a fortune doing that. I was investing during the dot-com boom, and there was Sausage Software and Computershare, which is still around, by the way, but a whole lot of other companies like that. And they were all the rage. And of course, most of them went broke. I took a tip off a bloke and then bought the shares, and then they crashed, so I sold them again, and then they went back up again, but thid already sold them because I didn't really know what I was doing. Mate, I've made all the mistakes. Hopefully that means I can avoid them next time around. But yeah, if there's a mistake to be made, I've probably done it. I didn't try and day trade. I'll give myself that credit. I didn't get to that extent, but mate, the rest of them, I absolutely made those mistakes.
Oh, absolutely. That's good lessons to learn, as you said, for when the chips are bigger, Scott. So who are some of the best mentors you've had that help sort of shape your philosophies?
So I don't want to, this is going to sound like a plug, and it's not. Well, it is, but it's not intended to be. Way back in the day. So I was sitting at a desk at work in 1998. And I was reading the back pages or the business page of the Sydney Morning Herald. It used to be a physical paper. Again, kids ask your parents. And I read about this. I was just investing something. These people mentioned the Motley Fool. And this is genuinely the story. It's not about because I work there. I'll tell you that in a second. But that's a stupid name, fool.com. What the hell is that? So I type it in, fool.com. I start reading. And back then, it was a ad-supported business. They had nothing to sell. I was just doing free content for ads, and that, of course, that model blew up with the dot-com bust. But in 1998, it was kind of getting towards the peak, and they would publish, as I said, 6 or 8 articles a day. And I read them all religiously. It just made sense to me. And so I learnt from those guys, the two founders, the Motley Fool, Tom and David Gardner. Some people your listeners won't know, but viewers, won't know. People like Bill Mann and Rex Moore and Jeff Fisher and people at the Fool who were they had a knack of explaining things really simply and easily in a way that they weren't talking down to you, but they weren't trying to pretend they were super smart or make it too hard to understand. They was like, hey, here's the thing I know. Let me explain it to you in a thoughtful, intelligent way, in a way you can understand. So literally, honestly, that's where it started. After that, it was, the usuals. It was Warren Buffett and Charlie Munger. Not personal mentors, unfortunately, but they're reading and writing some of the great books, mate. Good to Great by Jim Collins. Any of Peter Lynch's stuff, Beat the Street One Up on Wall Street. Just some really, really great content. So most of it, honestly, I won't say self-taught, but most of it was learned through reading or stuff people were writing or the greats. I've been lucky enough to go to the Berkshire Hathaway annual meeting, I think 3 times. I own shares, for full disclosure. It just clicked with me. But not many personal mentors, mostly lots of reading and sort of understanding the world around me.
Great. And that Berkshire Hathaway AGM, did you have to line up at 2 a.m. to do the dash and get the seats?
So I will tell you, I've been there 3 times. 2 of them with the Motley Fool, and we actually got press passes, which is one of the coolest things I've ever done. But the very first one, it absolutely was. You line up at the front of the door. And when they opened the hours, it was cold. For some reason, I'm an idiot. I went there without a jacket. I don't know what I expected it would be like. It was maybe April or May. It must have been a late April, early May. And so it's, that's kind of getting to the US summer, you kind of figure, mate, the Midwest, Omaha, Nebraska is cold at 2 o'clock in the morning. So yes, lined up, ran in, grabbed my seat, the whole thing. It's a heck of an experience. It's great.
Fantastic. Press passes. That's what I've done wrong.
That was cool. Yeah.
And what do you reckon the best piece of advice around investing or money that you've received is?
That's really hard, isn't it? Man, honestly, it's not a single piece of advice, but it's an approach, which is think long term. I guess it is advice by definition. When you zoom out, the minute to minute, hour to hour, day to day, week to week, month to month, year to year stuff, when you zoom right out and you look at the Vanguard index chart is my go-to, right? And it's 30 years of showing where the share market's gone. And yes, there's the occasional bump and jump and dump and all that kind of good stuff. The COVID crashes in there and other things. But if you take a long-term view, all those really big movements at the time, the big gyrations, in hindsight and with the benefit of that long-term view, you're almost not exactly hard to see, but you look at it and go, man, was that it? Was that what we were worried about? Were things always going to get better? Yeah, probably. Didn't they? Yeah, they did. We have just kind of chilled out? Yeah, we really should have. Think long term, whether it's picking stocks, staying with your investments, thinking about your investment horizon, your portfolio. Long term is where it's at. And if you get that right, everything else is really, it's not easy to do, by the way, because it's still scary and it still sucks when the market falls 38% as it did during COVID. That sucks to be anybody doing that. But if you know and you have a really, really a deep belief in the long-term potential, and you can kind of use that as your touchstone, it makes a huge difference.
Yeah, that's probably one of the best graphics I've seen, that Vanguard volatility poster. I've just never seen one that puts everything on one sort of one place and puts context in it. So, and again, if you were just like giving advice to your younger self on how to kick things off, what would you do differently or give advice to yourself on?
Just start and commit to doing it regularly. Time in the market, dollar cost averaging, those kind of things. They're kind of cliches, but they're cliches because they're true. That's why cliches end up being cliches, because they get said so often because they happen to be right. Get started and keep going. It sounds almost negligently simple, but it literally is. I mean, there's other things. You're going to be diversified. There's a whole lot of things to get right in investing. Not that many, by the way, but a lot. But getting started early and keeping going is probably the best way to think about it. I also made a very, very silly decision to splurge on a car when I was about 26, I think. And I've done the numbers on that. That $60,000 car, I got a car allowance at work, and I could have kept it. I went, I got a car. I got to spend on a car. Of course I should. It's free money, right? That $60,000 car is probably going to be worth cost me about $1 million worth of retirement savings. So that was a painful lesson. I loved it at the time. I'm not even sure I genuinely regret it. I did enjoy driving it for a while, 4 or 5 years. But I look back now and go, oh, you idiot! If you just keep your hand in your pockets, invested that money rather than buying yourself a car, that could have made a massive difference. But these things happen.
Yes, Mr. Moyer's compounding wouldn't have agreed with that one.
That's right.
So, and just sort of take me through, I guess, like you got kids, haven't you, Scott? Young kids.
Yeah, I've got a 12-year-old and a 29-year-old.
Yeah, yeah. And so, like, if you were going to help advise them, which they probably don't listen to you too much, but in getting started and that sort of stuff, what would you be telling them around what to avoid, not to do, and where people like that generally trip up around wealth creation?
You know what's really hard about trying to give advice to kids is no, they don't listen to me, but they it's not their fault, but they can't conceptualize the long term. If you try and tell a 12-year-old to save till he's 15. I can't even imagine that. A third of next year, it's not their fault. They don't have the frontal lobe development and the life experience to kind of go, hey, when I'm 65, I'll be really pleased I did this thing. It's really, really hard. Even at 18, even at 20, I mean, there's a reason that, our frontal lobes aren't developed properly till we're 23, 24. So it's really, really, really hard to say what you tell young people because I don't know, I'm not an educational expert or a development expert to know what to tell them that makes a difference. But what I think the mistakes to avoid are allowing the short term to be too important and following fads and fashions rather than fundamentals. Those are probably the two things that'll other than not getting started, not eating regular, as I talked about before. You want to be diversified, of course, but even then, if you're 12, 13, 15, 20 and you're starting with $1,000, being diversified helps, but it's not going to be the make or break, right? It's not until you get larger amounts of money that you get big swings that do make that much difference. Excuse me. So I think I'd probably say, think about, here's what I'd say. Aesop was right. The tortoise and the hare. Investing is the tortoise and the hare writ large. It's all that it is. It's the only thing that there is, right? That is how you are successful as an investor. But you learn to be the tortoise, not the hare. So I'd probably tell them that parable. I'd probably try and talk about, the benefit of slow and steady winning the race. I'd probably try and talk about the things that they think are important. My young bloke wants a Lamborghini, right? He's never going to have one, but he thinks he wants one. He's going to get one. So, okay, mate, let's say if you're a Lamborghini, whatever it is that turns them on, that gets them kind of thinking about, what if I compound some money? The other quick bit of advice, I've got my young bloke, it's a Sharesies account. I'm not sponsored by them, not paid by them. We have no affiliation with them. It's got $150 in it, right? But he's bought 5 or 6 different shares, and some of them have gone up. And so I get to say, mate, look at this. You made money by doing nothing. Yeah. And the first time he looked at me like, real, is that a thing? Like, wow, that's amazing. That was a real light bulb moment for him. So if I can kind of bottle some of those, all you want to do is the other thing is show them, do it with them, let them see you do it. Not necessarily with dollar amounts, because kids can't really conceptualize large amounts of money, and you got $1,000 in the pocket. The kid thinks you're rich and can't work out why you can't spend it today. But go through. I'm buying shares in Woolworths because I'm buying shares in BHP because here's what we do. Here's why I invest. Tell them about you. Let them observe you doing it, and some teachable moments as you go through it.
Love that. That's great. Making that connection to businesses and so forth with tangible businesses and so forth. Just take me through like Scott Phillips's investment philosophy. You've already sort of alluded that you've got some Berkshire shares, but are you a passive or an active guy? You like to single stock invest, or you do like a nice broad-based approach? What's your personal philosophies?
That's a really good set of questions, actually. There's lots wrapped up in all of them. I'm trying to think about actually individually versus overall. My overall investment philosophy is, I'll go back to Aesop, it literally is slow and steady wins the race. I'm a super long-term investor. I hope there are shares that I own that I'll give my kids. When I finally shuffle off this mortal coil, right? I'm in it for the absolute long term. And people think long term is a year or 5 years. Long term is decades. Like long term is past you. So I'm a super long term investor. It's what I am for. I don't hold everything just because I bought it once. I'll happily sell it if it doesn't make any sense to hold anymore. But I want to hold for the absolute, really, really long term. So that's probably the starting point. Second, I'm a fundamentals based investor, and people go with growth and value. I don't love those dichotomies. Charlie Munger say they're joined at the hip, right? Growth and value are the same thing. You can't have value without growth. You can't have growth without value. They are two sides of the same coin. But I think what better describes me is I'm a fundamentals investor. So I'm looking at the businesses themselves. I look at the business and say, what does the business do? How does it make its money? Where does it get its growth from? What's it going to look like in 5 or 10 years' time? That's, again, long term, right? I don't care what the share price is going next week or next month. I'd love to know because I could trade it, but no one knows, so I'm not going to try. So I'm absolutely fundamentals based. I'm absolutely long term. I'm absolutely business focused. I don't do thematic. I don't do top down. I don't do any of the trading stuff. I don't use technicals. I don't use charts. I'm trying to find good businesses that hopefully become great businesses. I want to pay a decent price for them. It's very much Warren Buffett's thing of finding a wonderful business at a fair price. That's kind of exactly what I'm trying to do. And then let's let time do the rest, right? If you find great businesses with long-term growth potential, I don't mean hyper growth. I'm not talking about growth like a Facebook or a Nvidia or whatever, right? I'm talking about just the businesses that are going to keep being a bit better and a bit larger every year. Did that for long enough. Look at Woolies it was $2.30 at the listing, something like that. It was now $30. I mean, that just did its thing, right? All you do is hold the shares. And by the way, reinvest your dividends too, because that's a powerful part of the investment story.
Yeah, great. So nice bottom-up approach there, Scott, as I would say.
Actually,
investments.
Let me answer the other question. I do both passive and active. I own some ETFs, but larger they are international ETFs. I'm a stock picker by trade, right? So I bought individual stocks as well. But I'm not. The other thing I've noticed, I'm not ideological about anything, almost anything. So I'm not just bottom. I'm not just individual companies or ETFs. And if it makes sense, I'll buy it, right? I bought them some Nasdaq ETFs because I wanted exposure to the US market. I think tech's going to be a really significant part of our long-term growth story. And some of the companies within that are great businesses. You can buy one package, so I own that. I own a Vanguard Global ETF because I want passive exposure to the rest of the world. And then in Australia, I've got a couple of ETFs here, a Small Ords and a ASX 300, largely for my young bloke. But then individual, I've got probably 15 individual stocks. And I invest in the US directly as well. So I own Berkshire, I own Alphabet, Amazon, Mercado Libre, Shopify, a couple others.
Yeah, brilliant. And just going back to that sort of macro outlook, I know we've chatted offline about the RBA today.
Yes,
but what are your sort of viewpoints around the Aussie economy and things like interest rates and so forth? What are you seeing out there? Because you're talking to a lot of people across different spectrums.
Yeah.
What are you seeing and hearing, and what's your viewpoints?
I'm going to zoom back a bit, actually, John, to start with and say, be an optimist. Long-term, be an optimist. This too shall pass. I think we get too caught up in the short term, honestly. So I will come back to your question, by the way. It's a really important one. But as an investor specifically, if I say to myself, how much does today's rate decision matter to my investing? Not at all. How much does next quarter's GDP matter? Not at all. How much does this month's unemployment matter? Not at all. How much does this month's retail sales? Why? Because I've just said I'm a 10+ year investor. Hopefully, like literally, I said I intend to live off my investments and then give the shares to the kids, right? If I'm lucky enough for that to work out that way. So why do I care? Why don't I own shares in Woolies? So I'll use it as a great example. Why do I care if Woolies sales are up or down 2%? If they're going to be bigger and better in 10 and 15 and 20 years time, if the price is reasonable today, why would I care? So from an investing perspective, I think that's important. I think it's important to know what is actually impactful on your investing. Now, the economy and some of the policy issues are really important. If people follow me on Twitter, I love a Twitter rant, right? So they're really, really important for the society we live in, for the fairness, for the economic growth, for prosperity, for jobs. Those things are really important. That's why I'll answer your question. But for my investing, I've never ever looked at something and gone, I will buy or sell those shares because of this economic stat or this short-term outlook or even this medium-term outlook. If there's a recession next year, there's a recession next year. If there's not. I don't know. We can't know in advance, so predicting it is silly. But even if I knew, would it change what I invested in? No, not if today's price is good relative to where the business is in 10 years' time. What it goes through in the meantime is kind of irrelevant, right? Sounds neglectful, sounds weird, but it's absolutely true. If I know my dollar today is going to be worth $10 in 10 years' time, whether it's worth 20 cents or $2 tomorrow is completely irrelevant. I'm going for the dollar to 10 over that period of time. What do I think about the economy? We know the GDP is weakest in yonks pre-COVID. I think it goes back to the GFC. So that's pretty ordinary. We're kind of bumping along the bottom. Discretionary spending is pretty ordinary. Rate cut today is nice, but inflation's still too high. We've had some tough times, I will say. Someone who's been through some actual proper recessions in the past. We think this is bad because we've had it good for 30 years. This is not bad. This is not great, but it's not bad. And it's certainly not terrible. We've been through those as well, right? So we've got to kind of keep some perspective. It's really hard if you're under a certain age. You haven't lived through a recession as an adult, let alone as some people here who've never lived through a recession at all watching this. So the economy is in okay shape. It could be better. We always want it to be better. We should make it better. We should do things policy-wise and otherwise to make it better. But it's okay. what's great is unemployment's really low. If you'd offered me 4% unemployment at any point in the 80s, 90s, or 2000s, I would have laughed at you and said, yes, please, I'll take it, but it's not going to happen. The fact we got there is fantastic. Now, we got there in part because of high inflation, so careful what you wish for. Not because of inflation, sorry. Inflation and unemployment were two sides of the coin, which were driven by that excessive growth. So we got inflation, we got lower unemployment. Okay, but you kind of couldn't have one without the other, and that's the price we paid. So that's really good. I am hoping that this year is actually a good year for retail spending, for discretionary spending. I suspect even before the rate cut today, retailers were picking up. And I think we'd kind of made our peace with the higher costs. It's not the level that people have issues with, it's the change. So once you get to a certain level, okay, inflation's 3.5, interest 4.3, that sucks. But after 6 months, 12 months, 18 months, you're like, oh, I'm used to that now, okay. And then you start to grow again. And that's really positive. So I think we were there already. I think the rate cut today will help that. So probably pretty optimistic for retail spending the rest of the year. The question is unemployment. If unemployment stays low, we're sweet. If unemployment rises, if businesses lay people off or don't hire people, then the cat's among the pigeons.
Yeah, great. And how would you suggest people position themselves for this sort of climate that we're in with rates being higher and that sort of stuff than they were the last few years?
So mostly don't, as I said before. Again, which sounds negligent. Just investing great stuff's going to be worth more in 10 years' time. Like, just don't worry about it. With a couple of exceptions. So that's generally my view. By the way, I have not changed a single investment because of rates going up or down or sideways, and I won't do it. I have no interest. I can't. But by the way, market knows what I know, right? So if lower rates are good for share prices, well, guess what? By the time the mortgage, okay, they're already priced in. So now what am I going to do? The opportunity's gone once everyone knows the thing. So nothing is the answer, except what the last little few years, really back to COVID, have taught us is if your company's got a lot of debt, you're playing Russian roulette. The question is how many bullets are in how many chambers, and you can't know that in advance. Star Entertainment shareholders may well find out. Mosaic Brands went broke. It was Katie's, Noni B, Rivers. They went broke, right? Why? Because they had too much debt, not enough sales. Warren Buffett says leverage is the only way a smart guy can go broke. Now, I'm sure these days you say a smart person, but either way, if you haven't got too much debt, you're fine. Transurban didn't have too much debt until it did during COVID. Sydney Airport was bulletproof until it had too much debt during COVID. So rates, if you've got debt, then you are at the mercy of debt markets and you're at the mercy of rates. So I would say to people generally, be careful of all of that sort of stuff. Be careful of concentration of risk. So this is not about where we are now. It's about what are the things that we've learned about or can learn about that will save us from the next time things get tough. Be diversified by currency, by geography, by market, by industry. Not two of everything. You're not Noah. You don't have two of everything. But make sure that your entire people say, I've got all four banks. I'm diversified. It's like, well, you are if one bank goes broke. But if there's problems across the entire economy, you're not diversified. You're going to cop the same heat no matter what, right?
Yes.
So be diversified. Be thoughtful about debt. But mostly, honestly, ignore what's happening right now. So, with again that exception, I'm trying to work out which business am I going to be really glad in 10 years' time that I owned today. So I'm looking back, future Scott is looking back 10 years and going, which ones will I be glad I own today? Now, not with any sort of crystal ball, but generally, how do I do that? So which one's going to be bigger and better? Which is going to be more profitable, more valuable? That's what I'm looking for. The exception is, or not the exception, but the rule is, they have to be around to make it to 2030 or 2035 or 2037. And so when you think about the companies that you own, the companies with debt, they might be fine by then if they get through, if there's a recession, if there's some other black swan event between now and then, and they go broke on the way. There's no point saying, well, if I hadn't done that, I'd be fine. So, well, if it happened, that's where you went. So build your portfolio accordingly.
And that's really good, this comment and get around what you're saying around giving debt respect. And it's pretty easy for me to log into a lot of social channels at the moment, and all the talk is about leveraging up and going hard at leverage and that sort of stuff. And I feel like that flies in the face about this disrespect thing. So what? And it's pretty easy to know what spruikers are sort of suggesting this sort of stuff. So what are your viewpoints around that? What word of caution, anything like that, or?
I've found a couple of Warren Buffett quotes in. I'm going to throw another one in. There's a business called Long-Term Capital Management, and they were a hedge fund that blew themselves up. There was 12 Nobel laureates, right, the smartest people in the world. And they got together and said, hey, we've got this great computing power. We're smart guys. Let's build a hedge fund that can't possibly go broke. Now, of course, they tempted fate and it went broke. Warren Buffett says they gambled what they had and needed for what they didn't have and didn't need. Now, think about that, right? The statisticians will say, if I give you, if you got $50 and you either double your money or lose it, that's an equal bet according to either you get 100 or 0. The average is still 50, so you're still fine. Now you ask the average person in the street, hey, would you rather have twice as what you got now? Would you take the chance of having twice your current wealth, but if you lose, you go broke? Almost no one's taking that bet, right? A couple of mad people will, and if that's you watching, have a good look at yourself. Why? Because it might be the same statistically, but going from 100 to 0 versus 100 to 200, the extra 100 will change your life. Not as much as losing everything you've got. I mean, that changes your life in really serious ways, right? So, debt can be constructive. Debt can be useful. Businesses use debt to grow. People use debt to buy houses. Mortgages are inevitable because no one can save that much cash. So use debt really, really wisely, but don't chase the nth degree. Don't chase the extra percentage point of returns by taking outsized risk. You just don't need to do that. And ironically, the younger you are, the less risk you should be taking. Why? Yeah, you got plenty of time to make it back, but that's not the point. You don't need to. If you're 20 now, you got 47 years of compounding before retirement, and you're probably gonna live another 30 years after that. I mean, you got 4/5 of your life ahead of you. Just basic rule of 72 compounding, the Vanguard index chart. Choose whatever you want. You'll be as long as you don't screw it up by taking too much risk or playing the games, or if you dollar cost average, keep going, keep adding regularly, be diversified, let time be your friend. You don't need to take risk. You're going to be completely fine as long as you're adding enough money as you go. Taking risk is seductive because what if it's a lotto win stuff, right? We know lotto's a bad bet. Why does everyone take it? Because we dream about maybe I'll win. And if I do win, look how much money I'll have. And people do that with investing all the time. And again, I'm not saying never, ever do it. I'm just saying have a think about, again, Transurban Sydney Airport, the debt was fine. How could it possibly go broke? Sydney Airport, one of the best companies in the country, got a monopoly. What could possibly go wrong? Well, COVID. Oh, okay, that's a problem then, So just really, the black swans, the 1 in 100 chance, well, guess what? If you live for 100 years, you're going to have it happen to you once. If you've got a 1 in 100 chance of going broke, and you live to 100, you do the maths, right? Don't put yourself in a position where you are jeopardizing what you have and need for what you don't have and don't need.
Fantastic. I like that. What was that? Taking risk is seductive or something like that.
Yeah, it is.
We've all seen those 40 mil property portfolios on there, and that is very seductive. So.
Yeah. By the way, I've spoken to a bloke who had 7 or 9 properties during the 80s, and the bank foreclosed said, mate, I don't like you having this much debt. Nothing wrong with his creditworthiness. They just said, you got too much debt, sell your properties. And he said, well, I can't, sell them all. He went broke. Because not because he couldn't service the loans, because the bank said, I don't want to lend to you anymore. That's all it was.
They looked at the balance sheet and felt it was too risky. So there you go.
That's what it was. Exactly. Yep.
That's fantastic, Scott. I really appreciate your time today. Just a couple more little ones. If you were to and I can see you got a great book collection there, one of them being Warren Buffett's Snowball behind you, the autobiography. But if you were to recommend maybe 1 or 2 resources or 3 that you'd recommend people that you found valuable, what would they be?
Read Good to Great by Jim Collins. It's a business book, not an investing book, but it will tell you about great businesses. That's super, super valuable. As much as I love the Snowball, read read the essays of Warren Buffett. Lawrence Cunningham is the editor. He's basically compiled and categorized all of Warren Buffett's shareholder letters back to 1970 something, I think it is. Buffett writes beautifully and elegantly and really insightfully about investing from a whole lot of different angles. He's been doing it for 50 plus years. All of that wrapped up and categorized by topic. Super, super, super useful. Really great way to think about investing. And probably One Up on Wall Street by Peter Lynch. Kind of reminds people how to, that they can pick stocks, you can invest, you can do well. Also gives you some little ways of thinking about categorizing companies and investment opportunities. Really super easy to read book. Some of the examples are a bit old now because it was written many years ago, but really, really useful book. Super, super thoughtful. One more quickly, Stocks for the Long Run. Jeremy Siegel, I think it is. A really good book. Just lays out the statistical case for why investing is worthwhile.
That's awesome. Thanks so much, Scott. I really appreciate your time. I know you're a busy guy. So where can people find more about yourself?
You've been very kind, John. Look, the Motley Fool's website is fool.com.au. Obviously, that's easy. Just Google it. You can find it. I'm on Twitter and Instagram and Blue Sky at TMF Scott P. TMF's the Motley Fool, so TMF Scott P. Facebook at facebook.com/Scott Phillips Money. just look me up. I'll be around somewhere. A quick heads up, my account gets spoofed every now and again. Someone tries to scam people by changing one of the letters in one of those handles. So just type it in directly and make sure you get in the real one. So TMF Scott P is the handle.
TMF Scott P. Great. That's awesome. Well, go check Scott out. He's got some awesome thoughts and content. Thanks heaps for your time, mate. I know you're busy, and I'll let you get to your day. Thanks, mate.
Absolute pleasure. Thanks, John.
Bye.